Our stock and flock is Dr. Ryan Larsen. Dr. Larsen is in the Applied Economics department and works hand in hand with us in ADVS in helping us deliver our programs. He brings some great experience in academia as well as practical experience. If my memory serves me correctly, he's from the big state of Idaho. So, Dr. Larsen, take it away. Go ahead and share your screen now.
Okay.
While he's sharing his screen, I'd like to remind individuals, if you've got a question, you can unmute your microphone and ask, or there's a chat box, and you can ask those through there, and I'll monitor that chat box as we go. Thanks, Dr. Larsen. I can see it.
You want me to mute my video so no one has to see me?
No, I'll mute mine. I think it's good that they see you.
Garcia would say otherwise, but okay. Well, Carrie just asked me to do an agricultural outlook for 2019. Just got back from St. George yesterday to the hay and forage. There's some great discussions there from both the export market, domestic market for milk and for forage. So talk about some of those things. Also talk about weather. I think as we look into 2019, I still think water availability is going to be number one. As already in some parts of the state, they're already looking at major cutbacks unless we see a major turnaround in precipitation. So, we're watching each snowfall. We got a good one in the southern Utah yesterday. So hopefully that can help out, but we need a couple more of those. So water is number one, and the rest of these follow. So like Carrie said, as we go through, if you have questions, comments, anything else, please just chime in. See if I can get this to go forward now. One of the biggest issues we've been facing, though, is lack of data. We use USDA to gather a lot of this updated data. So unfortunately, some of this is still 6 months to a year old, just because beginning of the year, we always have new data that comes out. And so those would be coming out in the next month. But until then, like an economist, we always have a good excuse for not having perfect data. But, hopefully here in the next little bit, we'll have updated data. So the first thing I'd like to talk about is the hay market. And what I'm going to use to talk about the hay market is a model we built. We looked at hay prices from 1990 to 2016 and found these 5 key variables that can help us forecast what hay prices are going to do within the state of Utah. On the supply side, the 7-state May hay stocks. So looking at that, so if we're trying to predict 2019 prices, we're looking at those 2018 May hay stocks for the 7 states here in the West. And also national corn price, that's going to be an indicator of supply of corn. So those are our 2 supply variables that are key in predicting that hay price. On the demand side, we're looking at exports of alfalfa. Some major changes going on there. National milk price is a good indicator of demand for that good high quality alfalfa, and also national feeder cattle price. So those 5 variables we found on the statistical side can predict within 93, can account for up to 93% of the variability in hay prices. So as far as an economic model, it does a fairly good job, and we have some confidence in it. When we look at some of those key coefficients, so on the 7-state May hay stocks, as that supply goes up, remember that supply-demand relationship, as that supply goes up, for every 100,000 ton increase, it reduces that change in price by $1.22. So on the other side, if there's a decrease in that supply, we're going to increase that price of alfalfa. National corn price, for every dollar bushel increase in national corn price, we see $11.33 increase in the price of alfalfa. Exports, as we see that demand, as exports increase, logically it makes sense that price of that alfalfa would go up. Milk price and feeder cattle price have the same, with milk having a little better influence on the overall price, with a little higher coefficient, a little higher impact than feeder. But those 5 variables are good predictors. For example, when we look at how we did predicting 2016 with this model, the 2015 average price was $166 a ton, 2016 $140. We saw a $26 decrease. When we use our same model, we come up with a $27.60 decrease. So you can see the model is doing what we'd want it to do. So we have some confidence as we go forward. When we look at those hay stocks, so this is December 1st, already you'll be noticing a pattern that those hay stocks are down in December. So that'd be December 2018. We're seeing is that those stocks go down. Weather is driving a lot of that here in the West as we saw those dry conditions in 18. Now this is May 1st, as we see beginning of crop year. So that's our May hay stocks, right? We saw those dramatically high stocks 15, 16, 17, drastic reduction 18, and forecasted, just that May 18 is being forecast just to be a little higher, but drastic reduction in that May hay stocks. And when we think of that previous model, as we see a drastic reduction in stocks, we're going to say, okay, supply's down, that price is going to go up, and we'll see that result here in just a second. When we look at corn futures, so these are the corn futures as of mid-January, we pulled these prices. This is $377 a bushel, $386, $394, $396 across the board. These are about 20 to 25 cents higher than we saw a year ago. So there's a little optimism in corn right now as we look into the future. One of the key variables that we're watching with corn is that as the soybean market has been hit so hard with the China tariffs, a lot of farmers as we go into 2019 are deciding, do we plant corn or soybeans? And there's a big push right now that there's going to be a dramatic increase of corn acres just because farmers are a little more confident in delivering corn versus soybeans. So that's something that we're going to have to watch closely as the spring unfolds, whether soybean acres have been replaced with corn and what that impact, that increased supply has on the corn market. But overall, a 20 to 25 cent higher price than we saw a year ago on the corn side. On the milk side, so these are each month has a futures market. So we're looking at January through December futures market. We can see there a 10 cent, 45 cent, all the way to $1 difference across 76 cents. So almost a 50 to 60 cent average increase on those milk futures. Yesterday at that hay and forage, we had Rick Nairbout from the Idaho Dairy Council talking, and they're seeing a similar thing. They're seeing a little stronger, a little better projection for prices in 19 than we saw in 18. Nothing drastic, but still a little better. So class 3 is on the fluid side. So this is representative of the fluid side. Class 4, which I don't have price for, class 4 is more the cheese side. So a little in the early part of the year, we're showing class 4 or the cheese side a little more optimistic. Later in the year, we're showing class 3 or that fluid side a little more optimistic as we go forward. But all in all, if that 50, 60 cent change as we go forward. On the feeder cattle futures, so these are the futures from January to November. Negligible change or difference from 2018 of $10 to $6 below. So, there's very little information in the futures. And recall, we use the futures market to gauge the expectation of where those prices are going. So, we like to look at those as an indicator of where prices are going to be. And really the feeder cattle futures are not showing anything dramatically different than what we saw in 18. So we're showing that. Then finally, the exports. So here's the alfalfa hay exports in blue, showing that trend up as we've seen those exports grow dramatically over the past 10 years. The black line there shows the trend line. So trying to fit that trend line to predict where we're going to be. We had Tom Bailey who's a large hay exporter yesterday say, China has been imposing 25% tariffs on hay exports, on hay imports right now. So that's really been slowing down the hay exports to China. But other countries, Saudi Arabia, United Arab Emirates have been increasing. But overall, there's a lot of uncertainty in those hay export markets, especially with Roundup Ready. Says China, when things are flowing easy. China doesn't care about Roundup Ready, but all of a sudden they can flip a switch and start denying Roundup Ready imports into that country. So he says there's still a lot of uncertainty on that Roundup Ready alfalfa going into China. So as we look at that, take those into account, each one of those changes based on our model, we're expecting a price in 2019 to be $24 greater than what we saw in 2018, with that average price in 2018 right around that 150, 155 mark. So basically a 2019 projection of that 175 a ton in the state of Utah. And that's an average, right? And so that's going to vary based on local conditions, local demand, but on the Utah average, that's the price that we're projecting going into the year. On the cattle side, we've seen this growth in herd. So 2018, we saw almost a 2% increase in herd size, up to 36.5 million head. You can see from 14 onward, we've been growing that herd. But one thing to note is that the rate of growth is increasing at a decreasing rate. So we're starting to see that curve flatten out a little bit, and kind of see that better as we look at this graph right here. The projection, there's two schools of thought going on right now. Are we going to continue to grow at a slow pace? Are we going to decrease that rate? My opinion, we're going to continue to grow at a slower pace. So almost that green dotted line for projections as we go into the future. But in either way, we're seeing those inventories grow. When we look at where that inventory growth comes from, this is the January 1st cattle inventory. We've seen, we saw an overall change in 19. Cows and heifers that have calved remain constant. Heifers 500 pounds and over, constant. Steers 500 pounds and over, up. Bulls are constant, if not down just a tiny bit, but constant. And then those heifers, steers, and bulls under 500 pounds. And our calf crop is where we've seen that increase there. So you can see where that drive in cattle inventory is coming from with a larger calf crop. We look at cattle on feed coming out of USDA. So this red line is 2012 to 2016 average, 2017 dotted, 2018. So we were well above average all of 2018 with cattle on feed, and expecting that to stay consistent as we go into 2019, above the average there with cattle on feed, with low feed prices and whatnot. Cattle feeders have been doing pretty decent. So we'll expect that trend to continue. Dairy cow inventory, right, 2018, we're starting to see a little indication, right? Those milk prices have been tight, margins have been tight, starting to see a slight reduction in inventory. Rumors coming out of southern Idaho with dairy starting to sell cows, sell their dairy cows. But we're starting to see some of those drops. And I think that's reflective of the dairy market right now, as we're starting to see some of those dairies go out of business. And some of that is seen right here in dairy cow slaughter, right? We're starting to see that pick up. And I still think that's reflective of the conditions in dairy that's gonna do that. When we look at commercial beef production, right, annual per person consumption right around that 57-pound retail weight. We're looking at that largest since 2012, so we're starting to see that increase in consumption. That's right. That's reflective here. So this is commercial meat and poultry production by type. Turkeys stayed relatively flat. Chicken, right? Chickens absorbed some of that demand. Pork stayed relatively flat. Beef, right? We've seen a slight pickup recently, but not dramatically. So we're watching that beef demand pretty close. When we look at that retail price, we've been above the 5-year average in 18, following 17 relatively closely, but still well above the average. So that retail beef price staying strong, keeping those that price in check. When we look at that as a comparison, compare that to pork, broilers, right? Beef has been been trending upwards, following a little different pattern than some of these others. We always like to think of chicken and pork as substitutes for one another. Oftentimes we say, you know what, those aren't really substitutes for beef, but the consumer may argue with that as we look at, uh, as we become more price sensitive, as conditions may change within the economy, the consumer may start to switch that out because of price. So when we look at that as a summary, demand was neutral or slightly positive for 2018. We're watching for competition from other meats in 19 if that broiler market becomes tight. But otherwise, there's nothing really that indicates any major changes on the demand side for beef in 19. That's kind of driving, we're not seeing any major changes on the fed cattle and calves in 19. And a lot of that's coming from that, right? Lightly like increase in supply, demand staying constant, really no major changes going on the fed cattle and calves. Now, keep in mind that could change if we see a dramatic change in the dairy market and we see a lot of dairy cows going into the slaughter market. That could change. If we see weather impacts, that could change. So we need to be watching those key variables as we go through 19. Four major markets, one of those key variables is beef trade. Of course, Mexico and Canada, we watch closely. Japan, South Korea. China, right? We always talk about China. China and beef is difficult because of the sanctions they put on the restrictions that they put for those things coming in. It's very difficult for us to determine how much beef is really going to go into China. And the wild card on here is, right, we're still waiting on the final NAFTA 2.0 to come through, as Mexico and Canada are so important for us when we talk about agricultural trade, that we need to watch what happens to that. Hopefully that gets put into place soon. And of course, we're watching China to see what the impact is there and if we can get those things settled as we go into that. As we look at those beef exports to major markets, Japan is still and South Korea, right? Those are the ones we need to be paying attention to, and Canada, Mexico, solid consumers, solid buyers. That's why we so want that NAFTA to be right to come into place so we can solidify our trade agreements with those two countries. Need to maintain on the beef side those South Korean and Japan relationships as they are major buyers. I'm going to look at feeder cattle now. Like I said earlier, no major changes, right, as we look into the futures market. So nothing. As we look at calf prices, Utah data we're still trying to work with our state guys to get good Utah data, but those auctions are dwindling. So we're watching Wyoming prices, right, trending upward, spiking there during that 2014 time period, but still a trend upward in prices as we look at those calf prices coming out of Wyoming, which should be relatively close to what we see out of Utah. When we look at those predictions for Utah, prices likely for those calf prices, 145 to 160 for the 500 to 600 pounds, right? But that could vary based on quality, head, demand, supply conditions, but not a lot different from what we saw in 2018. So still looking at a similar range that we saw before. When we look at those cow-calf returns, still showing some positive into 19, right? So this is just the cost of producing that calf and the return and the revenue that you get, just looking at that difference. The thing I like about this graph is it shows the cyclical nature of calf production, of producing calves, and that, ranchers and producers of that need to be aware that, manage their finances tightly so that they can weather some of these downturns, but still showing positive returns as we're going into 19, which bodes well for our Utah cow-calf producers. Just spend a few minutes on the corn market. You may have some questions on corn. We're coming off, multiple years of strong yield coming across the nation. Here locally, still once again, how much water are we going to have to produce that corn in the coming year? Exports are projected to be lower, but exports are a small portion of the corn market, right? Most of the corn is still used domestically, going from high fructose corn syrup, on the food side, feed side, and then of course ethanol. So we're looking at those key demand drivers as we look at corn. Corn production, like I said earlier, has remained strong. We continue to have record-setting yields, and this is just adding to the supply and inventory available for each one of those. So strong corn production has really increased the supply, and that's driving a lot of what we see on the price side, is just because there's not that uncertainty in inventory. So we're not seeing those prices that we saw 5-6 years ago. When we've seen that demand, so this is corn feed use and residual, demand staying pretty steady. Our ending stocks, we always like to look at those ending stocks, but like I said earlier, we still have those strong ending stocks that are driving the prices that we see today, ending stocks being a proxy for our actual inventory level. When we look at those corn futures, that's reflecting a lot of that information, right? So that those corn futures, right, just a little bit higher than we saw last year, driving that, some of the uncertainty on the soybean market, uncertainty in yields, but still we're seeing just a little bit higher than we saw last year. Milk, we've already talked a little bit about milk. Dairy cow inventory talked about. One of the things that to notice, though, is that milk production, right? We may be reducing actual number of cows on the dairy, but production is still up just because we're getting more efficient in our genetics. These cows are producing more milk. So, as we talk about this oversupply of milk in the market, just cutting cows, we may be cutting the number of head, but it's still production is strong just because of how efficient we are at producing. And you can see that we're well above the average here in 18 and 17 from where we've been in the past. Looking at those futures, right, that's showing that change from 18, a little more optimism. Break even, when we think of break even price should be right around that 15.50 mark for most producers, right? So we can see that we are either under or barely above that break even price, and that's driving a lot of those tight margins in the dairy markets. Just there's very little wiggle room based on your break even price. So milk hopefully a little higher in 19. Feeder cattle steady, corn price a little higher, hay a little higher. But that's my thoughts as we go into 2019.